day, critical planners. My name is Mr. Simbi, and welcome to today's accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. Welcome back again. Last week I promised you that after ledger accounts and the major shareholding, I'm going to be doing the statements, that is your financial statements. So today I have with me my financial statements, and to begin, I'm going to start with a statement of comprehensive income. Here are my objectives for today's class. I'm going to take you through the format of the statement of comprehensive income, and I'll also do the statement of comprehensive income. I have an activity that we're going to do together, and I'm going to do certain notes to the statement of financial position, because in grade 10 you did the statement of comprehensive income together with the statement of financial position. In grade 11 you did the same again. So there are certain adjustments that I'm going to do that I'm going to take from the previous years as well. So here is more information. The statement of comprehensive income reflects the trading results in the form of profit or loss for a specific accounting period. We're talking of 1 year. At year end, all the income and expenses accounts will be checked to ensure that all figures represent the amounts for the current year. And then adjustments will be done to rectify any accruals or prepayments. So we are going to be doing that today. We're going to be adjusting for any accruals or prepayments. We're going to be doing that, and we're going to be doing certain calculations to ascertain how much are the accruals as well as the prepayments. The net income or net loss is obtained by subtracting expenses from the income. Here is the format. So first I'm going to start with the trading section of the statement of comprehensive income. All right, so here you're going to find your sales less debtors allowances. Very key that whenever you are given debtors allowances, you subtract them from your sales, and then you end up with your 100,000 there. Remember, these are figures that I've just made up so that you can understand the format better. And then you have your cost of sales. So in most cases, the examiner can give you the markup percentage, and then they want you to calculate cost of sales. Or they can give you the cost of sales, and then they want you to calculate your sales. So you just have to watch out for that. And then you get your gross profit. And then you have your other income. On your other income, you can have quite a number of items that can be recorded there. For instance, here you see I have discount received, I have rent income, profit on sale of an asset. I'm going to touch on that aspect today, because whenever you have challenges with your fixed assets, you need to polish them when there is still time, so that you can be able to calculate either a profit or a loss on the sale of an asset. In today's class, I'm going to show you when we dispose an asset. And then we have bad debts recovered, as well as provision for bad debts adjustment. And then after that, we're going to add all of these. That is what gives us that 8,000 up there. And then you add that to your gross profit, then you end up with your operating profit, which is down there. And then once you have that, you subtract your operating expenses, and these are your operating expenses. And you can see I have two that are highlighted in red here. Those two are your new expense accounts that are unique to companies. So we did not do these ones last year. No, we never did these ones last year. These are new and unique to companies. So we're starting with these ones. The first one is your audit fees. Your audit fees. These are the fees that we pay to our external or independent auditors. These are the fees that we pay to our independent auditors. And we also have another one called directors' fees. Remember that we have shareholders as the owners of the company, and then we have directors who are responsible for the day-to-day running of the company. So whatever remuneration that we pay them for the services that they are giving, we call that directors' fees. Okay, so for you to understand the other parts that are different, let me take you back to the sole trader. You remember the one-man business? We did this in grade 10. All right, in the sole trader or the partnership, once we get to the operating profit, we'll just add your interest income here and then subtract your interest expense, and then the statement of comprehensive income was done, finished. Okay, But when you come now to what we're doing this year, remember, we're dealing with companies, okay? Companies, and the owners of the company are shareholders. Remember that? Okay? Shareholders. These are the owners of the company. They're the ones who have contributed capital to this particular company. And what we're going to be doing now is when we get to our profit or loss before interest expense, we're going to subtract the interest expense here, and then we get what we call profit before tax. Then we call that profit before tax. I'm going to show you that how do we then calculate your income tax over here. But one of the things that can make it very easy for you is that whenever you see your profit before tax, remember that it is 100%, 100%. And then your income tax will vary. I think some of you can see that in your different papers, it comes, at times it can be 30%, at times it can be 31%. But in this context, it is 28%. So we'll come and subtract our 28% here. That therefore means our net profit after tax becomes 72%. Very, very important that you understand that. So in grade 12, we're going to be considering income tax, and we subtract that in our statement of comprehensive income. There are certain questions that are going to come in most exam papers. It can be this much in the June, the prelim, or even the final. And we call these ones the low-hanging fruits. These ones you can easily pick. I don't expect you not to get marks out of these ones. Once you see these ones, you must quickly get them because these are free marks. But in every lesson, whenever I come here, I'm going to be doing these ones at the beginning and when I'm about to say goodbye, so that you can keep practicing on this type of questions. So even as I'm speaking, I'm giving you time to see if you can answer them, if you can attempt them, and then we are going to mark them together. Okay, so let's do it together. The first one, it says, one of the key things that you must do is to read the instructions. Read the instructions. And the instructions here say, choose a description from column B. This is column B. That matches the term in column A. And this is column A. Write only A to E next to the question numbers in the answer book. Okay, so first we have an independent auditor. What is the answer here? You see that your answer is E. The independent auditor expresses an unbiased opinion on the reliability of financial statements. So your answer here is going to be E. Are you still good? All right. So remember, if you missed all this concept, I did them in the first lesson, and I think last week I touched a bit of this. All right. Your independent auditor. Can I go on to the next one? Capital employed. What is capital employed? Your capital employed, it is the total of ordinary shareholders' equity and non-current liabilities. So your answer, therefore, will be D. Here it is D. And then current liability. What is current liabilities? All right. Current liabilities, once you hear the word liability, you know we're talking about debt. So these are debts to be settled within 12 months. So the answer, therefore, would be B. And then lastly, financial assets. What are financial assets? These are investments such as fixed deposit over a 3-year period. So when our fixed deposit will mature over a 3-year period, it becomes a financial asset, which falls under non-current assets. Non-current assets. It is only when it's going to mature within 12 months that we take it from the non-current to the current assets, cash and cash equivalent. But in this question, when we talk about financial assets, it is our fixed deposit which will mature over a 3-year period. Therefore, the answer here is A. Continue practicing on this type of questions. Next week, I'm going to bring again some more simple and interesting questions like this. All right. So we're going to begin, and we're going to take an extract from the NSC June 2019. Yes, it's been years. All right. And we're going to look at this. It is the statement of comprehensive income, there are some interesting adjustments that I want us to do together. So, as usual, you need to have somewhere to write. By now, you should have received the answer book. There is a worksheet that was distributed. So, you can inquire with the teacher. Just ask your teacher if they do have this worksheet. All right. If you don't have, it's not a problem. Get a piece of paper, and as I'm explaining, you write together with me. If you're able to download the paper from the internet, you can download the paper. This is the NSC for the year November 2019, the June paper, the June for the year 2019. And it reads, MVVS Limited. The information relates to the financial year ended 31 March. This is very important. The dates. So here our financial year is ending on the 31st of March. We are used to one starting in March and ending in February. But this one is ending in March. That means it begins on the 1st of April 2018. It begins on the 1st of April 2018 because remember, it is ending on the 31st of March 2019. Then we have to complete the statement of comprehensive income, and we have to do these notes as well. So as I said, I know you have problems with the fixed assets, but this year we don't want to make excuses. So we are going to work on these fixed assets so that if they do come in the paper, we are ready. No removals this year. Okay, let's go. Here is more information. And then we come to this one as well. So the first adjustment A. So whenever you are doing your statement of comprehensive income, you must do your adjustments in the order that they are. That is, you go from A to B, C, D, E. You must do them in their order. You cannot do A, then go to C, then go to G, then come back to B. No, it has to be A, B, C, and D, going on like that. And today, I'm going to show you how to do exactly that. Okay, so the adjustment reads here, a credit invoice. In my mind, at the moment I hear the word invoice, I know that we sold goods on credit. So the sign already that I have in my mind is a plus. In my mind, I'm thinking plus. I sold goods, an invoice is a plus. A credit invoice for 36,720 after deducting a 10% trade discount. Very key. This is a trade discount. Issued on the 31st of March 2019, was not recorded. Here are the key parts of the adjustment. This invoice was not recorded, and goods are marked up at 70% on cost. Let's see then, what are we to do? We are to prepare the statement of comprehensive income. All right, so make sure you have your table and let's begin. The first thing that I would do when I'm preparing my statement of comprehensive income is to start by saying sales over here. So can I do that? So I'm going to come here and I'm going to say sales. Then I open my bracket. I come here. I take my 10 million. That is 10,563,280. I also have my cost of sales over here. I open my bracket as well. How much do I bring? 6,236,000. 6,236,000. Like that. And I know that the difference between these is supposed to give me gross profit. It gives me gross profit. Okay. Now, I also know that at any point, my cost has to be 100%. My cost will be 100%. And the gross profit is my markup. That's the profit. So my gross profit is 70%. That gives me my sales in this case. My sales would therefore be 170%. Like that. Okay. I need to record this credit invoice. I need to record that credit invoice. I know that when an invoice has not been recorded, it will affect a number of accounts. And to make that simple for you, we call it the diskette. We call it the diskette. So I'm coming here and I'm writing it here. So we're going to have our debtors control, our sales, our cost of sales, and our trading stock. That's diskette. Okay? And then we now need to know the amounts. We are told here for the invoice, the amount on it after trade discount was 36,720. So here's 36,720, like that. And one thing that I know is that when it's an invoice, I'm going to come and say to my debtors plus, to my sales plus, to my cost of sales plus, again plus, but to my trading stock, it's a minus. All right, so I can do this first two, 1 and 2. I can do those ones. So I can come now to my sales and say plus 36,720. That one is not a problem. I can add my 36,720. And I know I would therefore take it to my trade and other receivables. And I'll start with my debtors control. All right, so I'm going to say here, I'm just going to say debtors control. And then I'm going to open my bracket and I have my 578,000, and I'm saying I have sold goods and that was not recorded. So I'm coming here to say plus 36,720. I add that as well. So I've recorded in two places now, debtors control as well as sales. Can I go on? Let's do that. So the next part now, I need to record in my cost of sales and trading stock. Okay, so since I was given my 36,720, I want to ask you, will I be right if I take the 36,720 and then I say multiply by 100 over 170? That is going to create a lot of problems for me. So let us rather say this is not the right way to do it. The right way to do it, if you want to get your cost, you would know that this is an invoice after deducting the 10% trade discount. So the best way is to get what was the intended selling price before the trade discount. So what I know is this 36,720 is not the 100% because we have already taken out 10%. So this is 90%. 90%. So what I therefore want is what was the 100%. To get that, I would therefore say what I want is 100. What I have is 90. Then I multiply this by my 36,720. Let's get the adding machine back. All right, I have misplaced my calculator, and then if I can quickly calculate that for me, and then you're going to get your amount, which is 40,800. So it becomes 40,800. That was the intended sales amount before the trade discount. So if I'm to calculate cost of sales, I'm going to calculate it from the 40,800, not from the 36,720. No, that would be wrong. First, I had to get what was my intent, what was my initial selling price before the trade discount. Then I can get my cost of sales from there. So it was 40,800. Then I can now say multiply by 100 over 170. How much is that going to give us? That's going to give us 24,000, like that. So I can now come and say, on my bottom part here, it's going to be 24,000. So first, where do I go? Cost of sales. I come to my cost of sales and say plus 24,000. We've sold goods, our cost of sales goes up. And I go to my inventory, my trading stock. All right, so I come to my trading stock. And I open my bracket, I start with the 364,200. Then I'll say 364,200. What do I then do? I subtract subtract, because we have sold goods to our customers, so goods have gone out. My trading stock is going to decrease. So I come here and say minus 24,000. As simple as that. All right? We're going to quickly take a 2-minute break, and then I see you after this quick and short break.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinikanga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Welcome back, guys. Before the short break, we were calculating a credit invoice that was not recorded, and there was a 10% trade discount. So we wanted to find what was the initial amount, and we did all of that. And then we took a quick short break. Obviously, you know where I'd gone to look for my calculator. And now I have my adding machine, but make sure you have your calculator as well, so that whenever we are doing these calculations, it becomes easy for all of us. Can we go? Let's go to the next adjustment. The next adjustment then reads, the physical stock count on 31 March reviewed the following on hand. So we are now at a point where we are having our physical stock count. So in order for us to do that, it's very important that whatever we have recorded, remember, initially we're coming from an adjustment where we have already recorded some amounts. So here on my inventory, I have my trading stock, okay? And then I have my 364, remember that? 364, 200, which is this one. And we have just recorded an invoice, all right? That was not yet recorded. Remember how much that was? 24,000. So here it was minus 24,000. Now we are being told that the physical stock count on 31 March reviewed the following on hand. What was on hand? Trading stock, 334,500. Okay, so what we're going to do is we're going to come here. Whatever is on hand is what comes into this very last column here. So I'm going to come here and I'm going to say my trading stock on hand is going to be 300 and 34,500. 334,500. Once we are told about trading stock on hand, the examiner wants to see if we can calculate trading stock surplus or trading stock deficit. What happens is we have stock according to business records. This is stock according to business records. But we also have stock on hand, physically counted. So when the two do not agree, it means we either have a trading stock surplus or a trading stock deficit. So in this case, we know that we had stock of 364,200 and we subtracted 24,000. Let's see how much that difference is going to give us. So if I say 364,200, remember we subtracted the 24,000 like that. The difference would therefore be 340,200. The difference would therefore be 340,000. So here to be 340,200. That is, if I consider this amount and that 24. So according to business records, we must be having stock, which amounts to 340,200. But that is not the case on hand. On hand, we have 334,500. That means, according to business records, our stock is 340,200. But when we physically counted, we only found 334,500. That means there is some stock missing because the records are saying 340,200. But physically, we have 334,500. So there is a gap in between the two. How much is that gap? So to get that gap, we'll now say 340,200 minus 334,500. And that difference is 5,700. So it means I can come here and say minus 5,700. If I close this bracket, it will then give me my 334,500. The 5,700 that I've subtracted in here, that simply means according to records, we have more, but according to physical count, we have less. So we have a loss of stock. All right. We therefore are going to record what we call a trading stock deficit. So I'm going to come now here under my operating expense, and I'm going to say trading stock deficit. Trading stock deficit. All right. And then I've shown you the calculations. If you want to show the calculations, you are simply saying 364,200, 364,200, and then you say minus 24,000. I'm simply repeating what I did there. Then you say again minus the 334,500, 334,500. You close this bracket, you end up with 5,700. That is our expense, trading stock deficit. Okay, I'm going to move on to the next one, which says consumable stores on hand. But let me do it over here. All right, so whenever I'm seeing now my consumable stores on hand, it tells me when we bought consumable stores, it was 53,200. So I'm going to come here and I'm going to say under my operating expenses, consumable stores. All right, consumable stores. I open my bracket and it's 53,200. And then I say, I have not used 3,400. It is still on hand. It is left. If it is left, it means it was not used. So it is not a cost for this year. So I'm going to come and say minus 3,400. I subtract my consumable stores on hand like that. And then I'm going to end up with 49,800. And those consumable stores on hand, I'm going to bring them here now and say consumable stores on hand. And that is going to give me 3,400 like that. That is how I would do my inventory adjustments. I'm going to move on to the next one. Let's quickly do so together. Can I do so? Let's go. Here's the next one. And it reads, Debtor S. Magnum was declared insolvent. Okay. This simply means our debtor is no longer able to settle his account. There can be a number of reasons why a debtor can be declared insolvent. Okay. A debtor S. Magnum was declared insolvent. His estate paid 2,000, which was 20% of his debt. So it tells us therefore that his initial debt was 100%. The full debt was 100%. How much was that? We don't know. They don't tell us how much that was in rands. But what we know is when he was declared insolvent, his estate paid 2,000 rands, which is 20%. So here they paid 20%. Okay, they paid 20%, which is equal to 2,000 over there. Now, the difference must be written off as bad debt. What difference? Remember, they were owing 100%. They have only paid 20%. The difference, therefore, is 80%. So the 80% has not been paid, and we're being told to write it off as bad. You know what is bad debt? When a debtor can no longer settle the account. That's an expense. But we don't have the rand amount. How do we do that? Remember the UK method. What you want over what you have times what you have will give you what you want. Let's use figures now. You see that your want will be different from your have, because your have will have two values, your want will have one value. So your have will have 1, 2. What is it that you want? They say the difference. So the difference is 80. So I want 80. What do I have? I have 20. And the 20 is equal to the 2,000 rands. Let's see. Adding machine. All right. So what is it that I want? I want 80. What do I have? I have 20. And that 20, I multiply that by 2,000. How much am I going to get? I end up with 8,000. So 8,000 is what will be written off as bad debt. As bad debt. You have to know that when we do adjustments, we have to consider their effect in the statement of comprehensive income, but as you did in grade 11, the statement of financial position as well. So let's see. I'm going to come here and I'm saying operating expenses. What do I write here? Bad debts. Bad debts. I open my bracket. How much am I going to get? 22,300. There is 22,300. What else do? I say plus over here. Plus how much? 8,000 plus 8,000. Like that. We still together? Okay. But once I have bad debt, I know once I have a debtor, it must affect my debtor's control. So I'm going to come to my trade and other receivables. Remember, we've already adjusted for that invoice, adjustment A. So I'm going to come here and I'm going to now say, what do I say? Is it a plus or a minus? Remember, this is the debtor that is being written off. Is it going to increase our debtors or decrease our debtors? So I'm going to come here, I'm going to say minus 8,000, like that. Are we still okay? Cool. All right. Can I go on to the next adjustment then? Let's quickly do that. Let's go on to the next adjustment. Adjustment D. What have you seen so far? I did adjustment A. I went to B. I went to C. Now I am on D. You can see that adjustment A had an effect on adjustment C. So if you jump all these stages, you are going to have problems. All right. So you need to do adjustments in the right order. We good? All right. It reads 1,800 was received from a debtor, Jamie Sting, whose debt had previously been written off. So Jamie Sting had a debt that was previously written off as a bad debt. Now, when he paid us the 1.8. Our bookkeeper incorrectly, we are being told already that what the bookkeeper did was incorrect. He credited the amount to the debtor's control. Correct the error. Okay. Now, it is very important to understand what this whole thing means. Let's create a scenario. We have a debtor here, Jamie Sting. Let me just say here in the debtor's ledger. Okay, in the debtor's ledger. Okay, Jamie Sting. So here's a debtor. On the debit side, it's a plus. On the credit side, it's a minus. This debtor was owing us 1,800. He was owing us 1,800. And then we wrote off the amount as a bad debt for some reasons, maybe insolvent, or we couldn't find him anymore. So we come here, then we say amount 1,800. But here we say bad debt 1,800. What does that mean? On the debit, I have 1.8. On the credit, I have 1.8. That means here, this account has been written off. The account has been written off. This account is now 0. We have written off the account. We don't have a debtor by the name J Misting anymore. Now, this guy then decides to come and pay his account back. So he deposited money into our account, 1,800. And when our bookkeeper received this money, the bookkeeper went and recorded it and said, bank 1,800. What do you see now? We now have two entries on the credit side, 1.8, 1.8. Is that correct? Certainly not. Why? Because this account was already written off. This bookkeeper was not supposed to credit. The bookkeeper was not supposed to credit the amount in the debtor's control. The bookkeeper was not supposed to do that. And when the bookkeeper did that, that was an error. Now, let's correct this error. How do you correct it? If we're to remove an amount on the credit side, we remove that amount by putting it on the debit side. So we're coming again to our debtor's control. Here, you can still say control here. We're coming again to the debtor's control, and we're going to say 1.8. So what that means is I'm coming to my debtor's control, and I'm going to say plus 1,800. I am correcting the error that was done by the bookkeeper. The bookkeeper credited this 1.8 when the account was written off. Now, what was the bookkeeper supposed to do then? There are two accounts that the bookkeeper was supposed to open immediately when the money is received from a debt that was previously written off. Let's start with a simple one. If I can ask you a simple question, this money when it was received, in which journal was it recorded? CRJ. So whenever you're posting from the CRJ, remember, you always debit bank. So you're going to get your bank account and you would have your 1.8. Bank is receiving. CRJ, we're receiving. And then the second account that this bookkeeper was supposed to receive, to record rather, is what we call bad debts recovered. Bad debts recovered is an income account. So we're supposed to credit that 1.8. This is what the bookkeeper was supposed to do. But the bookkeeper did this one. So we corrected that here. And then now let's make the correct entry. So I'll come to my statement of comprehensive income, other income. Then I'll say bad debts recovered. Bad debts recovered. How much is that going to be? 1,800. Okay, let me open my bracket here. I had another amount there, which was my 6,000. So I'll say plus 1,800 like that. I can close off the bracket if you want, but let's go on. Then we just close all the brackets at once. We're still good? Thank you. Thank you. Let's go on to the next one. The next one reads Adjustment E. Adjust the provision for bad debts to 28,500. So provision for bad debts, we are making provision that some of our debtors may not pay. Some of our debtors may not pay. So the easiest way to go about provision for bad debts is to compare the previous year and the current year. That is the easiest way, where we say last year and this year. Last year and this year. Last year's provision was 30,100. 30,100. And this year's provision is 28,500. What do you see? Is it an increase or a decrease? It is definitely a decrease. If it is an increase, we consider it to be an expense. If it is a decrease, we consider it to be income. And how much is that difference? So we'd come here, then we say 30.1 minus 28.5. And the difference is how much? Okay, let me see. The difference is going to be 1,600. Correct. 1,600. That is correct. 1,600. Okay, that is our provision there. 1,600. So when I come here in the statement of comprehensive income, I'm now going to say provision for bad debts adjustment, open bracket. I'm simply going to check this calculation. All right, so it is my 30.1 minus my 28.5, and then I see that I have a 1.6. So that gives me income because it is a decrease. A decrease. The other way is simply to say last year minus this year. If it's a positive, it's income. If it's a negative, it's an expense. Last year minus this year. All right. Some would just say previous minus current. Okay. Previous provision minus current provision. And then if it gives you a positive, it's income. If it gives you a negative, then it is an expense. Then you take it to operating expenses. But then the provision for bad debts for this year, the entire amount, I'll take it, then I'll subtract it from here, which is 28,500, like that. The entire amount, I'll take it into my trade and other receivables, like that. Let's do so. Let's move on then. Let's move on. The next adjustment reads, insurance includes an annual premium of 51,000 paid for the period 1 January 2019 to 31 December. So we have an insurance annual premium of 51,000. We know that our financial year is ending on 31 March. If it's ending 31 March 2019, it means it began on the 1st of April 2018. That is 12 months over here. And we also know that this premium was paid until 31 December 2019. Okay, so how many months was it paid in advance? From March 31 to December 31. Okay, so if we count, we can use our fingers. We can say it's going to be March. Do we count March? Certainly not. Okay, because the financial year ends on 31 March. So if we don't count March, what do we count? April, May, June, July, August, September, October, November, and then December. How many months is that? 9. So 9 months were paid in advance. This is 9 over 12. How much was it that was paid? That's 51,000. How much are we going to get? Let's see if we can get a calculator. And then we're now going to say it is 9 over 12, 9 over 12, 9 over 12. And then we're going to multiply that by 51,000. And that is going to give us 38,250. Yes, 38,250. What is that? That is the prepaid expense. So I'm going to come here and I am now going to say insurance. My insurance is 79,500 over there. But the 38,250 was paid in advance, 38,250. I subtract it. It's a prepaid. I subtract my prepaid expenses. And I take it now to trade and other receivables, where I'll have my prepaid expenses. All right. And then I'm going to open my bracket, and then I'm going to have my 38,250. In other places, you just find that they've already put in your debtors, and then you just come and add all your other amounts. They just give you a box if you find that in other exam papers. All right. But here I wrote prepaid expense so that we can understand what is it that I'm recording in my trade and other receivables. When we pay an expense in advance, it is receivable by the business. Next adjustment it is adjustment G. It reads, an employee was left out of the salaries journal, the following details are applicable. Net salary of the employee, 9,100. The deductions by the employer total to 30% of the gross. Employer's contributions were 2,200. Okay, so here we can see we have salaries and wages, we have employer's contributions separately. Let's see, we're opening in our statement of comprehensive income. So let's come and then we'll say salaries. All right, so I'm just going to write salaries and wages over here. I open my bracket and I have my 1,280,000 like that. And then I have my employer's contribution. Here's my employer's contribution. And for my employer's contribution, I'm going to open a bracket also. This is 316,000 like that. Now, we are told that we have a net salary of 9,100. So we know that we have a gross salary, and that gross salary is 100%. In terms of rands, we don't know. And then we will subtract deductions. That one we know. And the deductions that we're subtracting here are 30%. Which therefore means we end up with what we call net salary. And that net salary is 70%. In terms of rands, we know it, 9.1. Now, the gross is what goes into your statement of comprehensive income. The gross salary is what goes into your statement of comprehensive income. So we can simply do this in any way. You can get the deductions or you can just get the gross. Okay, some are saying let's get the deductions, then we get the gross. Okay, it's still okay. But maybe for time, let's just get the gross. To get the gross, we'll say we want 100 over 70. Multiply that by 9,100. All right, and then, so what we want is 100 over the 70, which is the net. And then we multiply that by 9,100. That is going to give me 13,000. So that means my gross is 13,000. Someone would have said, Mr. Simbi, please just show me how to get the deductions. To get the deductions, I would say 30 over 70 multiplied by 9.1. Okay, so that would be, coming back again here, I want 30, I have 70, and then I multiply that by 9,000 years, 100, and that will give me 3.9. So my deductions would be 3.9 here, 3,900. So you would see if we subtract that, you would end up with that. So I would take my gross into my income statement. So I'll come and say salaries and wages. I'm just going to say plus 13,000. That's it. That's it. All right. Someone is saying, what? But what if I was going to record them separately? If you had come and you had said plus 9.1, which is the net, plus 3.9, which is the deductions, you would see that they still give you the 13,000. So you would still be very correct. But the idea is, in the income statement, we record our gross. Our gross is what we record in the income statement. Are we good? All right. And then we have another part. The employer's contributions were 2,200. So I'll come here to my employer's contribution. Then I'll say plus 2,200. This is easy now. This is easy. Okay. You can close the brackets when we are at the end. Okay. Let's go on. Let's go on. Let's do so. Adjustments and additional information. Interest on loan is capitalized. What does that even mean? A fixed monthly repayment including interest of 25,400. Very key. Fixed monthly. Monthly. Take heed of the word monthly. And we're preparing financial statement. That means this is for the yearly. But here we are given monthly. So in your mind already, you have to know that 25.4 must be multiplied by 12. Let's go on. So they say a fixed monthly repayment, including interest of 25.4, was paid for the financial year. What do they want us to do? They want us to complete the statement of comprehensive income. But we did these calculations in grade 10 and in grade 11. Let me remind you. We used to open what we call a loan account. Here is my loan account. A liability. That means on the credit side, it increases. On the debit side, it decreases. It's a liability account. And so I would begin it with my balance at the beginning. So I'll come here, then I'll say my balance brought down. That is 1,658,000. That was my balance at the beginning. Okay. And then I know that interest is capitalized. When interest is being capitalized, that means we are adding the interest. To make it simple, bring your interest to the side with the plus sign. So you simply bring your interest to the credit side. So capitalizing, so I'm going to say interest here. And then double lines. Double lines. And then I'm told the loan balance is 1 million. So I'm coming here, balance brought down 1,430,200, which I will bring here. Balance, this is carried down. This is carried down. The balance brought down 1,430,200. Okay. So I now come here and I'm told repayments are 25,400 monthly. So that means I'll come here and I'll say 25,400. Is that correct? Is that 25.4? Yes, 25.4. Multiply that by 12. That's going to give me 304,800. So I'll come here and I'll say my bank is 304,800. 304,800. We want to find this interest over here. To do that, let's simply add our debit side. And to do that, we're going to say 304,800 plus 1,430,200. That's going to give me 1,735,000. So I'm coming here, 1,735,000. 1,735,000 minus this amount here, minus 1,658,000, minus 1,658,000. That is going to give me 77,000. So my interest here is 77,000. So I can come here and now say interest expense. My interest expense in brackets is 77,000. You can show your calculations over here because you already understand what is happening there. If you want to show your calculations, you are simply saying, you can start with any figure, but you can start on your debit side to make it easy. That's 1,430,200. And then what did you do? You added the, how much did you add? 304,800. Then you say plus 304,800. And then what did you say? Minus the 1,658,000. And then you close the bracket. It gives you the 77,000. That is another way that you could have shown that in your statement of comprehensive income. But remember, you did that already in grade 11 and grade 10, the ledger account. So it becomes easy for you to be able to draw it up. Can I move on to the next one then? Let's do that. Oh, the interesting part now. Okay, I know most of you are waiting for this part, so we might as well do it then. Okay, so here we are given information that relates to our vehicles. And we are to calculate depreciation in our operating expenses. So here we're going to come and we're going to say depreciation here. I'm going to open bracket. Whenever we calculate depreciation, it is important to remember the sum. That is your sold, your old, and your new. Okay, so normally we'd have three: your sold, your old, and your new. Let's see here. So here we're going to do number one. Number 1. Let's begin. Our depreciation is at 20% per annum on cost. So when we're calculating on cost, what we need is just the cost. So I'm going to take the cost price of my vehicle number 1, which is 350,000. So I'm going to come in, say 350,000. And I'll say multiply that by 20 over 100. This is an old asset. It was there from 2013. So that means it's going to be 12 over 12. My old will be 12 over 12. Let's get the adding machine. So it's going to be 350,000 multiplied by 20%. That's going to give me 70,000. 70,000. Okay. Now, if I get this 70,000, that therefore means if I can calculate my carrying value, what is going to happen? My cost is 350. My cost is 350,000. My accumulated depreciation, here it is 315,000. Then I'm going to add that 70. I'm going to come and say plus 70,000. How much is that? 315 plus 70, 385 minus 385,000. That will give me my carrying value. Let's bring it on to the adding machine. So it will be 350,000 minus 385,000. That is going to give me a negative 35,000. That's going to give me a negative 35,000 on the carrying value. That's impossible. An asset that is physical in existence cannot have a negative value in the business books. So that means something is wrong here. That depreciation is wrong. That 70,000 then becomes wrong because an asset cannot have a negative carrying value. It simply means that once my depreciation causes my asset to end up having a negative, I remember now the 1 rand residual value principle. That is to say, when my asset is over depreciated, it cannot be recorded on a negative, like here. It can also not be recorded on 0, but we assign it 1 rand. So it means I'll come and say my carrying value is going to be 1 rand. My carrying value is going to be 1 rand. My cost remains the same, 350,000. So how much is my accumulated? 350 minus 1, that gives me 349,999. 349,999. Okay, let's do that on the calculator. We will say 350,000 minus 1. That will give us 349,999. That is now my accumulated. So it means if that 70 is wrong and I now have 349,999, how much am I going to add to the 315? Because remember, I already have 315,000, which is my accumulated depreciation. I must come and say plus depreciation, such that at the end I have 349,999. So what am I going to add here? In other words, I'm simply saying 349,999 minus 315,000. Minus 315,000. That is going to give me 34,999. So my depreciation therefore becomes 34,999. Like that. So my depreciation is not 70. 70 is wrong. My depreciation therefore becomes 34,999. There's another quicker way. Yes, there is another quicker way. Can I show it to you? Whenever you are calculating depreciation on cost, always check if my cost is 350, my accumulated is 315, how much is my carrying value? My carrying value, therefore, is 35,000. My carrying value is 35,000. Therefore, my depreciation cannot be 70. I cannot lose more than what I have. I can't lose 70 when I only have 35. That's what it means. From the 35, I can lose value due to depreciation, but I must remain with 1 rand. So I can say minus something is equal to 1 rand. That gives you 34,999. Or you can simply say your 35,000, which is the carrying value, minus 1 rand again, it gives you 34,999. So I'm coming here. My depreciation therefore becomes 34,999. We good? Okay, let's go on to the next asset then. Let's go on to the next one. Let's quickly move. Here's the next one. The next one is number 2. Number 2. Can we do number 2? Okay, let's do number 2 then. What are we doing? We're recording there. For number 2, we are told we are in 2019. It was purchased in 2016. So it's been there. Okay, it's been there. All right. So we're going to say 400,000 multiply by 20 over 100 multiply. Was it there at the beginning of the year? Yes, because it's from 2016. So 2018, when the year began, it was there. 12 over 12. You still following? Okay, let's go on. So I'm going to come here and I'm going to say 400,000 multiply that by 20%. That's going to give me 80,000, like that. 80,000. Any tricks here? No tricks at all. So I'm going to come here and I'm going to bring my 80,000 there straight on like that. No tricks. Okay? Let's go to number 3 then. Yes, number 3. Number 3. It was bought on the 30th of November 2018. Remember, the year begins on the 1st of April 2018. So this must be a new asset. Okay? That's a new vehicle. So I'm now calculating for my new. I'm going to say 627,000 multiply by 20 over 100 by how many months? When did we get this one? 30 November. When I'm counting, do I count November? Do I say November, December? I can't do that. Where do I start? Because it's 30 November, I'm going to start counting December. I'm going to say December, January, February, March. How many months do you have? 4 months. Multiply by 4 over 12. Let's see the adding machine. Come here, my friend. So it's going to be 627,000. And I'm going to multiply that by, okay, let's show it properly. 20 over 100. And then we say again, multiply that by 4 over 12. That's going to give me 41,800. 41,800. Like that. Okay? So, it means I now have my depreciation. I'm going to come in and I'm going to say plus 41,800. Like that. That is my new asset. So far, I've calculated this one. I've calculated this one. And I have just calculated that one as well. Okay, so let's take this now to our note. Remember, we're given the depreciation. That is the same one in the statement of comprehensive income. I'm going to come and bring it here, which is my 34,999 plus my 80,000 plus my 41,800. That is my depreciation. I close that bracket and I'm going to get my 156,799. That must be in bracket. Do I have any new assets? Yes. Remember that new one. Okay. What was the new one? 627. So that's my new asset. I'm coming here. Additions, 627,000. Did we dispose any asset? Certainly not. Can we complete this bottom part? Let's do it together. Okay. So how do we do that? Quite easy. If I want to get my cost, I'm going to look at my cost here plus my additions at cost will give me my cost at the end. Okay, so follow those small little triangles. So I'm going to say my cost at the beginning, where can I put my friend? Let me put him here. Okay, so my cost at the beginning, which was 750,000 plus my addition, which is 627,000, and then how much is that going to give us? It's going to give us 1,377,000. You see this one here, so we can prove that one. Okay, let's go on. We want to get accumulated depreciation there, over there now. All right, so let's get our adding machine again. What do we say? Let's give it a sign now. It's the circle now. All right, so the circle, then we come to depreciation, and then we get our accumulated depreciation over there. Can we do that? All right, so here's my adding machine. I'm now going to say 475,000. I'm going to add plus 156 plus 156, 799, like that. That is going to give me 631,799. So I come here, 631,799. Can I get carrying value? Certainly you can. How do I get carrying value? We're simply going to say 1,377,000. Oh, 10 too many. 1,377,000. Then you're going to say minus the accumulated of 631,799. Is that correct? 631,799. Correct. And then you get your 745,201. 745,201. Like that. Then your note is completed. You can still get your movements over there. Okay, but due to time, I'm gonna move on. Okay, in the next session, I'll do one well with you. Can I go? Okay, thank you. Let's go. Here's a different adjustment now altogether. And it reads, equipment was sold. So here now we are disposing. We are writing off an asset. On 31 August 2018, only the following entries in respect of the sale were processed. So the cost price was given, the accumulated at the date of disposal, 21.5. Depreciation for the current year. So it means this amount is in there. That's what it means, because this is at the date of disposal. So it simply means the 1,750 is inside the 21.5. That's what it means. Okay. So what are we required to do? Statement of comprehensive income. In here, we are to record either income or loss on sale of an asset. Profit or loss on sale of an asset. Okay, profit or loss on sale of an. Can I do an asset disposal with you? Let's do an asset disposal. But before we do the asset disposal, we're going to take again another 2-minute break. 2-minute break. And then when we come back, we do an asset disposal. So see you guys in 2 minutes, and we do an asset disposal.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinanga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Welcome back, guys. Before the break, we were looking at this adjustment that has to do with an asset disposal. So it is very easy if I can remind you of what you did in grade 11. So let's quickly open an asset disposal together. So I'm going to call this my asset disposal account. Here's my asset disposal account. They say equipment was sold for 9.6 cash. Only the following entries in respect of this sale were processed. So here we have the cost price, which is 28,000. So that means I'm going to come here and I'm going to say equipment. I'm just going to write EQT, and then that was 28,000 here. That is the cost price of my equipment. And then I have my accumulated depreciation. This is the tricky part. You would be tempted to add these two together. Do not add this, because as I've said, the 1,750 is already inside the 21.7, because this is accumulated depreciation at the date of disposal. So my accumulated depreciation is going to be 21,500. Then we're told equipment was sold 9.6 cash. That means I'm going to come here and it's bank 9,600. Then I close that off. I'm going to add this 2. That's 31,100. This is 31,100. And therefore, I'm coming here. This is profit on sale. Once the amount is on the debit, there is profit of 3,100. If it was on the credit, then that would have been loss on sale. So I can come here on my other income, then I'll say profit on sale of asset, and that is 3,100. If you want to show calculations, you are simply saying 21.5 plus 9.6 minus 28,000. That gives you your 3,100, which is profit. Okay, I'm going to move on to the next one. Okay, so here we are going to record depreciation. So you will see that already we're given depreciation for this asset that is being disposed. So I'll come here, then I'll say plus 1,750. And we are told in the last bullet that depreciation on the remaining equipment is 92,500. So plus 92,500 as well. And then we can then bring this on to our note number 3. All right, so remember, this is equipment. These amounts are for equipment. Okay, so the depreciation was given already, which is your 92.5 plus your 1,750. That is how we get here. The 1,750 plus the 92.5. That is how we end up with the 94,250. But we know that we have an asset that was disposed at carrying value. And to get the disposal at carrying value, it's very simple. They're saying, what was the carrying value on the date we disposed the asset? What was the carrying value? To get the carrying value, you simply say cost. How much was the cost? 28,000. How much was the accumulated? 21.5. So what was the carrying value of this asset on the day we disposed it? That would be 6,500, like that. And you close your bracket. Okay. And to close this off, it is not going to be a big issue. So if you want us to close the bottom part again, we can do that together. All right. So remember what we did earlier on. Here there was no addition. So we'd say again, cost at the beginning minus your disposal. So you subtract your disposal. That will give your cost at the end. In other words, you're coming to say 398,000 minus your 28,000 over there. That is going to give you 370,000. And to get your accumulated depreciation, it's going to be very interesting again. You're going to say your accumulated depreciation at the beginning, 117,500. Okay, so it's 117,500 plus your depreciation for the year plus 94,250 minus your accumulated depreciation minus 21.5, and that would give you 190,250, like that. And then if you get the difference between these two, they'll give you that amount there at the top, which would be 179,750, and then that note is completed. Okay, I somehow misplaced my calculator. Let me see if I can find it. There you are. Okay, cool. We still have you. All right, let's move on to the next one then. Let's move on. Interest income is the missing amount. So here we want to get interest income. So to get interest income, we're simply getting the difference between the two, 768,000 and 742,000. So to get interest income, we're saying 768,000 minus 742,000. Okay, so to get that adding machine, it's going to be 768 minus 742,000. That's going to give us 26,000. So I come here, my interest income is 26,000, a positive amount. And then we go on income tax. So remember, this was the new thing that I also mentioned about, one of the other new aspects that come into our statement of comprehensive income. Then we're told income tax is calculated at 28%. That means my net profit before tax is 100%. My income tax is 28%. And my net profit after tax is 72%. And we're told that income tax is calculated at 28% of the net profit. The net profit before tax was 691,000. So I'll come here, it's 691,000. That is my net profit before tax. Okay? And then I'm now going to say income tax. To get that, I want 28. I have 100. Multiply by 691,000. I close my bracket. So I'll come here and I say, I want 28. I have 100. I multiply that by 691,000. That is going to give me 193,480. In bracket, 193,480. That can give me now the difference where I'm simply now saying 691,000 minus 193,480. That is going to give me 497,520. So you have 497,520. That is my net profit after tax. Okay, let's go on. Oh, an interesting one now. Ordinary share capital, note number 7. Okay, let's do this one now. It says ordinary share capital at the beginning, that's 4.8 million. So I'll just come here. Here's my 4.8 million over there like that. And then I know that my balance at the end is 9.3 million. So I'm coming here, 9.3 million like that. Here's my line, double lines. Line, double lines. The company has authorized share capital of 8 million. Is there any way I record that in note number 7? Not on the issued. Remember, here we're dealing with the issued. And then the company had 1.2 million shares in issue on the 1st of April 2018. So at the beginning, I had 1.2 million ordinary shares. This is at the beginning. Okay. And then it goes on to say 150,000 shares were repurchased. So the first thing that is happening is a repurchase. And before I do anything, I open brackets. How many shares were repurchased? 150,000 shares were repurchased. And these were repurchased at 825. Do I record the 825 in here? Certainly not. What do I need to do? To calculate the average price. For me to get the average price, I'm going to take my 4.8 million. I'm going to divide that by my 1.2 million. Okay, so it's going to be 4.8 million divided by 1.2 million. That's going to give me 4 rand. So my average price is 4 rand. So these are repurchased at 4 rand. So I'm going to say 150 multiplied by 4. So 4 times 150,000. That's going to give me 600,000. So I'm coming here. It's going to be 600,000 over there. Then they say 850,000 shares were issued. So I'm coming here to say 850,000 additional shares. Ordinary shares were issued at, we don't know. Can we get this amount? Certainly we can. How do we do that? We do the bottom up method. Okay, starting from the bottom, going up. Now, when we starting from the bottom, we're going to swap signs, but the bottom amount remains the same. In other words, I'm going to put my 9.3 million as it is. 9.3 million. The second amount that I see now, which is the 600,000, then I say plus 600,000. Then the 4.8 million, I say minus 4.8 million. Then that's how I get my 5.1 million, which I bring here to be 5.1 million. Can I get the number of shares at the end? I begin that by saying 1.2 million minus 150,000 plus 850,000. 1 0 too many again. 850,000. That will give me 1.9 million at the end. 1.9 million ordinary shares at the end. Now, you will see that we had a beginning, we had repurchase, we had addition. Okay, so for me to get my average price, I had to look at the B that is close to the R. I had to look at the B that is close to the R, which is the beginning. Hence, I took the one at the beginning and not at the end. I had to look at the B that was close to the R. Okay, is that good? My good friends, we've come to the end of today's lesson. It has been a pleasure having you in my class, but before I say goodbye, let's have one more of those low-hanging fruits. Okay, so it reads, choose an explanation from column B that matches the individual or term in column A. Write only the letter A to D next to the question numbers, that is 3.1.1 to 3.1.3 in the answer book. Then the first one is director. What is the answer here? The answer should be C, that directors manages the operating, financing, and investing activities of a company. So that is your answer here, C. You want to try 1.2. Okay, I'm going to give you a second to read it. Okay, it's saying unqualified audit report. So you cannot look at C now. You're looking at A, B, or D. Which one is it? Is it A? Is it B? Okay. Okay, that was a technical glitch there. Is it A, B, or D? Unqualified audit report. It is D, that the financial statements fairly present the financial position of the company. So here it is D. Then the last one, shareholder. All right, shareholder. So we are looking at A or B. Is it A or B? It is definitely B, the person who invests funds in a company. Thank you so much, guys, for joining me in today's class. It's always a pleasure and a joy to have you in my class. I hope to see you again next week, Friday, same time, 2 p.m. I'm here. Statement of comprehensive income and more interesting adjustments. If you know a friend or you do have a friend that is struggling in accounting, please invite them to join our class every Friday. We are here until we write our final exams. Until next time, enjoy your studies and goodbye.